It's time for Ultimate Options, and I'll tell you, this is where we dive in. We're gonna do an option strategy. Corey, what do you think, bud?
I'm so excited. Protective puts.
Congratulations. I really asked for your trust to learn a lot of things before we got to our first strategy. We learned about Greeks very early. We did a review of the 4 pillars, so we had a good refresher on fundamentals and technicals. We learned about the mindset of the trader. We learned about risk. We just learned a ton of stuff, all of which, Trading Journal, all of which now you're going to see it's going to come in handy because now we're going to do Kung Fu.
Yeah, and you have to build that solid foundation. It's kind of like the guy that goes in the gym and he wants to slam dunk, and it's kind of like, okay, that sounds exciting, but to really be a great basketball player, you got to know how to shoot and pass and play defense. And, so building that foundation, that was very, very critical to getting to this point in time.
I don't pass.
No, you're a shooter, man.
I tend to shoot the basketball. No, congratulations. Really, really for trusting Corey and I to do it that way first. The one thing you could ask is after every lesson, the thing I would ask is, okay, is after what you've just been through, would you want to know all this stuff before you do your option or after? Now, risk is important. This is actually going to be a risk management strategy. The risk we're going to have in this trade specifically is if it doesn't go far enough, right? We're going to buy insurance as if a house didn't appreciate. So there's very little risk here, very little risk, extremely limited risk. And it's going to be fun. It's going to be fun to do. So we're going to give education today. We don't give advice. We don't recommend anything specific. There is risk involved, and you've read this now enough that you should understand it. The first strategy we're going to do is a protective put. When I took my first classes, everyone started with a call, and say, oh, let's go make money, and the stock goes up. Actually, one of the great things that you can really save thousands and thousands and thousands of dollars over your trading career is to learn how to buy protection. The smart trader certainly can see options is something that we can do opportunistically, to make money. But the smart trader begins with a defensive mentality and harnesses the power of using options to play defense and limit risk. As an option principle, Corey, you manage risk every day, right? Not just yours, but you manage many, 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 many traders, and you make sure the firm doesn't lose capital. That's your deal. So
hey, defense wins championships. Right?
Defense does win championships, yeah. And so that's a married put. So let's look at a definition, and there's a slight, depending on who you talk to, it's the same graph, protective put and married put. But let's talk about it. A protective put is simply a risk management strategy that we're going to use to limit loss on a long stock position. So we're going to start here. You've bought a stock, okay? You own this stock, and we'll talk about some of the reasons when you might decide to do this instead of a stop loss. But that's basically the risk graph of a protective put. We'll draw one. We'll learn to draw it ourselves today, and it's going to be fun. Now, a married put, congratulations, celebrate. Is
dun, 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 dun.
There you go. Now it's essentially the same thing as a protective put, but some people give it a designation. To me, it's one and the same, but they'll say, yeah, it's a put, but it's when you buy it right at the money, married at the same strike and at the same time, where you put them on both at the same time. But the graph looks the same, and the purchases are just the same, whether it's at the money or out of the money. It's just that's it. So
that's right. It's the same strategy. The only difference being
when
it's married if you buy the put at the same time you bought the stock. But you can go in and buy a put anytime, and turn your long stock position into a protective put at any time. And at that point in time, they are married, right? The put is now protecting the stock. So
they're
exactly
married.
Right.
So it's a protective put. So I prefer the term protective put because it's the same thing, and off we go there. So let's look at the objectives on this. So why do people? And I'd highly recommend you take notes on this stuff. Okay, on the things I tell you are special because we'll use them later on in the lesson. But the first thing is anytime you want to limit the risk of holding a stock. If I have a stock, and it's going up here, and I get nervous about something happening to really lose a lot of money, I might take a look at buying a protective put, no question about it, to where it takes away this damage right here. This doesn't hurt me. It's like insurance. This can't hurt me. So if I'm really, really worried about the downside risk, I can eliminate the downside risk. Yes, you heard me right. I can eliminate the downside risk, a lot of it, most of it, the vast majority of it, I can eliminate by buying a put option to protect my position. Now,
yeah, and I think it's great that we started with protective puts. It's actually one of the, when you look at the most common strategies in the options market, the two most common things are protective puts, people buying a put to protect a portfolio or a stock, or covered calls where you're generating income. Those are the two most common strategies. And so it's always been interesting how people look at the options market as being risky. You'll hear that a lot. Well, in reality, the options market was created for this reason, so that you can go and get insurance and have less risk. So if you're using options correctly, you heard me right, you're risking less. Do I have less risk than the person just holding the stock? Absolutely. Because
less.
If that stock tanks, I have a put that guarantees me an out at an exit price at the strike price above. So as far as the stock goes, it doesn't matter. I'm protected. I'm insured. And that's a great thing.
I'll show you the difference in that risk just really, really quickly. Is let's go here, and the stock is going like this. Your risk now in the stock, let's say you got lucky and you bought this at $1 and now it's at $100. Your risk now is $100. So the risk is $100. If you decide to do a protective put on that stock, you bought it here at $1 and went up like this, okay, your risk now is, let's say you buy a put at a strike price that is right here, let's say. So now you've limited your risk to two things. Number one, you've limited it down here, so maybe it's 100, and now you're let's put that in the same ink. And now maybe your put was at like 96. So that would, the first part of your risk would be $4, because you could, have it go down there, would be $4. And then the second is your max risk in a solitary option. We'll just say the risk in the put would be the premium you paid. So let's say you paid a premium of $2. Now your risk, adding these together, now your risk is no longer $100. Now your risk is $6, and that's it. That's the most you could lose under any circumstance in that trade. So
6 is a lot more manageable than 100 and a lot less risky. So exactly right.
So we're going to protect a previous purchase, that you made. Maybe the market starts heating up, and earnings gives uncertainty. Okay, earnings give uncertainty, and so maybe the stock's going up like this, and you're fine with it, but right here you see coming, in time, you see an earnings report. You see an earnings date coming up like this. And you say, I just want to take about a window that big where, volatility goes up and buy myself a little insurance. So with short-term uncertainty, maybe the Fed is coming out with a big announcement. Maybe there's GDP numbers being released. Maybe the stock has earnings coming up. Anything where you say, this thing could roll. Now, there's a lot of stocks that will gap, right? They'll be going around and they'll gap on you. And so, they'll have a gapping personality on earnings dates where there's these gaps. And the problem is if I have my stock going here and I have an entry here and I set a target here and I say, well, that would be a nice target. And I set an exit here and I say that would be my exit. And I say, well, I'm going to put my entry in right here. That's fine if the stock goes down nice and smooth and hits that exit, no problem. Hey, I save the money. I don't need to pay for the protective put. All I do is lose that little loss down to maybe the support level. But if I wake up in the morning and the stock's gap down here, I've lost. I'm in trouble. If I wake up in the morning and there's a huge gap here. And there are many stocks that have a personality of gap, and around earnings, they gap more than others. So if you're concerned about a gap, instead of a stop loss, you could buy a put option at this point, and this will fill you with cash all the way down here, including the gap, and it'll compensate you for your trouble. And then
that put gives you a complete protection, whereas with the stop loss, you're getting out at the lower levels. And another thing to consider is it could gap down, stop you out, and then bounce all the way back and recover, and you're out of your trade. You've sold the stock if you had a stop loss, but if you have the protective put, you get to profit from all the recovery because it's an insurance policy. You had it protected when it was down. Now that it recovers and it takes off skyrocketing, you're still in the trade, where with the protective stop, you could have been stopped out prematurely.
And that happens a lot. It gaps down here, or it goes down here and gets you out, and then it goes and fills the gap, and you weren't in to recover, and so you lost this amount of money, couldn't get back in. It's a great point, Corey. And then also a cost basis. Let's say you bought this stock down here at $5, and you've held it, and you've held it, and you've held it, and you've held it for a long, long time. And it's gone from $5 to $30. It's really done well. And maybe it's happened over a period of time. Well, that's a $25 profit. And if you put a stop on it right here, because an event like earnings or it's heating up or whatever, you run into some short-term uncertainty, if it goes down and you sell with a stop loss, this now becomes a taxable event, unless it's in an IRA. And so you'd have to pay tax on this trade right here. But if you were to set it, instead of put a stop loss on it, just buy a put right here. Now if it went down, you could continue to hold on to your stock. Let's say it falls down to $15. You could continue to hold your stock, but you get paid this amount of money right here. You get paid. So maybe you put it in at 28. So now you'd get paid that $13 right there, and then you'd have that 13, and then as it goes back up, you'd have that good cost basis again. In fact, you could even buy more right here if you wanted, and you wouldn't have to sell the stock because you would hold it through the entire period, but you would be paid for that drop. So
that's right. You'd sell your put back to the market, and that's where all that value would come from. Yep. So it hedged. It protected your stock. Yeah, the stock went down, but my put went up. In contrast, I sell that put back to the market, monetize it, put that profit in my pocket. Then as the stock recovers, I get all that recovery, and I've locked in that profit on the protection. Great example.
It's fabulous, fabulous strategy. So I think it's one of the most conservative strategies to learn. You could certainly do this in an IRA. You could do this in darn near any account. And so on the aggressiveness meter, we're starting out way conservative. So let's just review, and I'm hoping maybe this is we're going to use the same formula in every single strategy. You're going to see the same slides, just with different different instructions. So let's take a look here. That we're going to assume that we're the buyer, and a protective put is long stock and a long put. So here's what happens with the stock. This guy over here says, I want to buy, 100 shares of, I don't know, maybe Corey Halladay Toilet Training Company.
Nice.
Okay. Yeah. Corey Halliday, I thought you'd like that. Toilet training company.
Yeah, I've got a lot of practice with that.
Right. And I want to buy 100 shares of this, and I want to do it at, let's say like $65 a share.
Well, if I'm running a toilet training service, it's a high price stock. It's
valuable. I know you have kids. I know you've been there and done that. Okay, so someone out here in the market is saying, "Look, I disagree. I think I want to sell this, so I want to sell. I want to sell 100 shares. We'll put that out here. 100 shares of Corey Halliday's toilet training company, and I want to sell it at $65. And so the money changes hands this way. Is you would now send your money to this guy. So you would send him $6,500. Is that right?
Yep.
So you send him $6,500, and that transaction, the first one, is complete. Okay. The second transaction that makes up this trade to make it a protective put is you're the buyer and you say, I want, and remember, a put gives you the choice to what, Corey? I want the choice
to sell.
To sell. Okay. So this is an option. I want the choice to sell my 100 shares at, and let's say we want to be able to sell it at, I don't know,
$60 or something.
Yeah, 60 in case it goes down. Sell it 60 for the next 3 months. For 3 months. Anytime between now and the next 3 months. And this guy says, all right, that's fair enough. I will give you a promise. I promise to buy this from you. And Warren Buffett does this all the time. Maybe he wants to pick it up at 60 anyway. Maybe he thinks it's going to go up huge. And he says, hey, if it dips, I'll buy it for 60. So he says, I want to buy, I promise to buy this at $60. At $60. I'll buy 100 of them, 100 shares at $60 anytime for the next 3 months. And since he is receiving this money, since he's the guy that makes the promise, always gets the money. And I don't know, maybe you could get a put like that for, like $1, probably. So you pay him $100. And so now for another $100, you have an absolute guarantee to be able to sell this at $60. And now your risk, instead of being $65, is $61. Or excuse me, is $100 plus 5. So it'd be like $600. So
exactly. So
go ahead.
Yeah, in this scenario, what you've done is you've bought two things. You've bought the stock at 65, so you're the proud owner of those shares of my toilet training company, and you bought the put option, right? And so both come with a cost. So your cost basis is the two combined. It's $66 in this scenario because you bought the shares at 65 and you bought the put for $1. So we combine those together. Now, because we're guaranteed to be able to get out at 60, if we have a 66 cost, our risk is the $6 difference, or $600 in this scenario.
If we buy this alone, our risk is $6,500. If we buy this alone, our risk is $100. But if we buy them together, our risk here is $100. But now, since we can sell what we bought at 60, now our risk here goes down to $500. So this $100 purchase right here takes the risk down from $6,500 down to $500 here plus your $100. So your total risk is now $600.
Exactly.
Pretty cool stuff. So that's what the trade looks like. Now, how does this affect your balance sheet? Well, you've got some long stock here in your asset column. And, even before we do that, let's get out of theater mode and let's play with this a little bit. Okay. Let's just play with this. Let's say that you had a home. So let's put a little house in here. And the value of that home can go up and the value of that home could go down. Well, the value of your asset minus your mortgage would give you a little bit of your net worth. And so your net worth could go up or down based on how this happened. Well, let's say you're nervous that a fire, look at that fire coming out of there, dude. You better get the wife and kids out. Fire's coming out of that house, right? Fire's coming out of the house. And so what you do is you want to eliminate this downside. You want to eliminate the downside and this downside in net worth. So what do? You say, look, I'm going to buy some insurance. So it's a very protective thing. So what would you say to someone who, if Corey and I told you and we said, look, we believe in buying homes without insurance. It's a waste of money. It's just a waste of money to buy insurance, let's say the insurance was only a penny a day. You get it for a penny a day or $1 a day. For $1 a day, you can get insurance for $1 a day. Well, my gosh, that'd be insane not to buy it, right? So the insurance, even though it's an expense, it's still an asset because it's protecting you. So you would go into your estate planner and you would say, I want to set up a trust where I have two assets. I have a house that I'd like to put in my family trust, and I also have an insurance policy, on my life or whatever. This house is insured. So this insurance takes away the opportunity for this to go down. Now, the house would have to go up in value at a faster rate than you're paying insurance for your net worth to go up. There's no question about it. If you're paying $100 a year for insurance, your house would have to appreciate more than $100 a year. Well, the same is true with your stock. And one of the beefs I have with retirement accounts like 401ks and RSPs and others is that it's the same thing. As the stock has the chance to go up or down, well, your net worth can go up or down. Well, if there's a fire in the stock market, a crash, in other words, this can go down really fast. So how can we do this? Well, we could use a stop loss, but what if it really gaps? So that's where we say, you know what? We're going to bring in this long put here, which gives us the choice to sell this stock if it goes down. So now the stock can still go up as high as it wants to go. Here's our net worth. It can go as high as it wants to go. But this put right here is going to build a wall at this point and say, we're not going to let you fall down very far. In fact, we're only going to let you fall down this far. So now, even though you're paying some money for this, you preserve your upside, you limit your downside. And let's just do some math here, Corey. Let's say that you had a significant position in something. Let's say it was $1,000 or 1,000 shares. You had a really nice position in a stock, and all of a sudden it hits rough water. Well, if that stock was at $200 a share, right? And you had a couple $100,000 worth of that stock. It's not like a Buffett could have $200 million, but let's say you've got a couple $100,000, or maybe this is in a retirement account, and or the company you're at. It's in your 401k, and your company owns that, or you own it through your company, and they say, look, you can't sell the stock. You have to get vested before you can sell the stock. Like in the days of the 1990s,
.com,
everyone was getting shares, but they said, look, we'll pay you in shares, but you can't sell. Well, if you went out and bought a put, if this stock falls from $200 down to $175, that affects your net worth by $25,000. You see that? And even if you don't have 1,000 shares in one place, let's say you have 10 stocks that are $100 a share, and you decide to use protective puts, this will save you thousands of dollars in a crash. Okay, and if you have multiple opportunities to use this can actually, over the life of your trading career, this could be a six-figure skill to have this. And so for someone to trade stock, I don't buy protected puts on everything, But there are certain times, as we spoke of, gapping times and times of uncertainty, where for very, very little money, you can be protected. If you were to go back and look at what you owned, if you're seasoned or own stock at all, I've done this in workshops that are live. For example, I was in Canada, and potash is in Canada. They make fertilizer, I think, or something like that. And potash was very volatile, and it was rocking and rolling. Then it just got crushed. And we had a guy that owned a lot of potash in the room, and we did the math on it. And this thing would have saved him about $15,000, this one strategy, just on that one stock, on that one drop. It has saved him, about $15,000 or so. So that was an expensive seminar he put on for himself. And he was very upset. Saying because when he saw it through the lens of insurance, he was very upset. He says, I was told to buy insurance on my house. In fact, the bank required it to get a mortgage. And I said, well, what's more likely to burn down, your house or potash? And he said, this is criminal that someone didn't tell me about this. He was very, very upset, to where for literally pennies on the dollar, right? These are pennies on the dollar. For pennies on the dollar, he could have insured himself, and you sleep better at night. So this is depending on how long you trade, if you have a 20-year trading career, 30-year trading career, the amount of value that adds up over 20, 30 years, this can be a six-figure skill. So that's what it looks like. Long stock. You got a long stock and a long put here, married together, living happily ever after, protecting you, right? Protecting you.
Yep. Pretty
cool stuff, right?
It's awesome. I mean, insurance, it's just as you've suggested. It's not a waste. Even if the insurance doesn't pan out, meaning you didn't need to use it, what a good thing, because your stock just kept climbing and you were in great shape. And so that insurance expires. That's, I'm never disappointed that my house didn't burn down. So that's a good thing.
If I buy a stock at $65 and it goes down to $64, that's going to be a $100 loss. If it goes from $64 to $63, that's going to be another $100 loss, and so forth and so on and so on. So this is the risk graph of what a stock would look like. Well, let's say I spend $1 for a put at 65. Well, that means that if or 64, that means that from 100, I'll draw this in blue, I think. That means that if I buy a put that lets me sell at 64, I'm going to have some protection starting at 64. Now I spent $1 for the stock, isn't that right? So I have 65 for the stock, and then I spend another $1 for the put, perhaps, right, Corey? And so now I have a really interesting risk graph where I have pretty much the same upside here as I had in this stock. We're going to do another risk graph exact, but see how now that I've eliminated this, and no matter how far down the stock goes, the most this could go all the way down to 0, and the most we could lose right here is this $100, right there. Pretty nice. Now we got to figure in the premium and all this type of stuff, but that's basically the idea roughly. And we're going to do one. We're going to do an exact one actually here in a bit after we get a little better with the numbers, but we're just going to start off right here with this simple risk graph.
Absolutely. And the two important points with this risk graph, notice how your risk flattens out. That's key, right? So instead of having that unlimited downside risk in the stock, we have capped our risk. It's flatline. And then you'll notice we parallel the stock. Now, we didn't participate quite as quickly because we did pay some money for the puts. So that comes into consideration. We have a little bit more cost than if we just own the stock, but we're okay with that. Otherwise, all that it goes up, we keep paralleling that. We just have that additional small cost for the put.
So if you were really stoked, right, about the stock and where you think it could go over the next 3 months, maybe you think it can get from 66 to 72 in 3 months, and you're really stoked about the stock, you have two choices to invest in that stock. You could do method A or method B. That's pretty interesting to put it that way. Is as you look at the risk graph, okay, which one would you prefer? If you're very bullish on the stock, it's got great fundamentals, it's got a good technical pattern, and you're bullish on the stock for the next 3 months. You think, you know what, this is going to be nice over the next 3 months. This could really jump, let's just say $6 more in this case over the next 3 months. Which risk graph would you want to have?
Yeah.
Which position would you take?
Yeah, if that put cost you, like your example, $100, you're basically mirroring the upside. You just make $100 less. That's it. Every dollar that it goes up, you make all of that because you haven't capped your upside in the stock. You still own the stock. All you've done is protected your downside. That's what the put does. So it doesn't cap your upside gains. You participate on the upside the same way, only you just have that additional cost of the put, which in many cases can be a very small amount, pennies on the dollar.
So let's say you could make $600 with a $6,000 of risk, right? That's choice B. Yep. If you think it's going to go up $6, you make $600 with $600 in risk. Maybe there's some resistance at 72. Who knows? Or you could say, I'll make $500. And my risk is only going to be $100. Okay, that's your choice. You can make $600 with $6,000 of risk, or you can make $500 with $100 of risk on the same $6 move. So you choose. It's an interesting way to put it, isn't it?
Yeah.
The only place where this would be a disadvantage is right here. I mean, that's it. That's the only place where it would be a disadvantage is if the stock only went this far, and you didn't, and even then, if it goes here, this is really not a bad place, right in this area. That's losing less and less. So really, the only really nasty place in this is right here. That's where you're, over here. Hey, you're happy, if it went down there. So this is really the only place where owning the stock here, would have been better than owning the put in terms of being profitable or not profitable. It's a really interesting way to look at it. Which graph you want? You want to invest in this one, or do you want to invest in this one? Which position do you want to take? Okay, so that's the basic outline of it. Now let's do an example with the Corey Halliday Toilet Training Company. Why not? And
absolutely,
I'll tell you what's fun is we wanted to make this as evergreen as we could, but we also want to make it very, very real, right? So what we actually did is we took real stocks. This is actually a real stock. It's not a real company here, but we took another stock. I'll tell you what, they're an oil stock, and we just traced over their chart. So this is a real chart. This is real volume. And this is a real option chain. So everything you're seeing here is real. We've just given it a different name to protect the innocent. But this is a real chart. This is exactly a real chart. It's not something we made up at all. And so the first thing we're going to do here is we're going to look at this information, the puts, the calls. And do you like the dual monitors, man? I mean,
that's
hey,
nice.
This is a trade station.
That's a trading setup. Absolutely.
I mean, this is a trade station right here. We got our dual monitors, man. We got the stock on one. We got the options on one side and the chart on the other. I mean, we know what we're doing here, man. Pretty nice little trading setup here. Hey, and if you don't have that, guess what? That's what Windows is for, right? Split your screen in half. So when we trade stocks and when we trade options, we always use the 4 pillars. And I'll tell you, the first thing we would say is what would be, like if we were just trading the stock, okay, we should trade the stock every time. So maybe our entry, it's at 64.97, so let's put that out here. And maybe our entry is just above that. Let's say if it bounces off this downward thing, or maybe we say, hey, we want to get it as a breakout, or whatever. But our entry would be somewhere around here. And it looks like, this has a tendency to form consolidation and go about that far. Consolidation, go about that far. So maybe we say, hey, if it repeats that, at least we have a reason for it to go about that far. And we say, you know what, we would like this to be our target. So we like that target. And then we put in a nice little exit right here. So there's our entry, there's our exit. And we say, hey, we'd be out, maybe a little bit below this resistance. And, right here, this, resistance, it could be support. So maybe it's a little below that, whatever you want to do. But here's the thing, you're going to lose this cash anyway, right? If you do it. And if it gaps down on you, you could lose even more. So we say, maybe we don't want to trade the stock. Maybe we want to trade the option. We're going to look at the options over here. So we're going to do our 4 pillars, right? We're going to go through every one. Let's do this one first. So this is from Yahoo Finance on this stock. These are real numbers. And the valuation here, we didn't go crazy with fundamentals. And dude, you can go as deep as you want to, right, Corey?
Absolutely. Yeah, dig in if you want to get into all the fundamental metrics and really get into value investing and those sorts of ideas. Nothing wrong with that.
And on the other side of it, though, don't panic if you don't. Because
sure.
because one of the things, I'll tell you, one of the things I worried about when I traded is I didn't understand exit strategy as well. And just understand that if you have good risk management, these can be much, much more forgiving if you have good risk management. I don't need every trade to go right. And I would rather spend my time on how to adjust a trade if it goes wrong than become an analyst. However, I do want to feel good. And so you say, look, it doesn't need to be that hard. There's just a few numbers we can look at to give us a basic good feeling. And they have to do with earnings and growth, right? It has to do with how well the company's doing and if they're growing. And if you get those two, you've got your good first pillar down to a degree where you can feel better about getting involved in an asset than if you didn't do those things. So we want a strong market to buy a bullish stock. An overall market should have an uptrend. We'd like a strong sector. Now we're going to look at a strong company. Boy, if this pays a dividend, that's even a bonus. So the first thing we said is this stock, above $10. If it's not above $10, it's not going to gap down $30. So if I have a stock that's $10, I own 100 shares. I've only got $1,000 at risk anyway. And, a stop loss would suffice. $1,000 isn't going to put us in the poorhouse. And so on cheap stocks, we already talked about we're probably not going to mess with options unless the stock is at least $10 or more. If it's a $5 stock, a protective put might be a little silly on a position of 100. Would you agree, Corey?
Yeah, I would agree. I mean, really, low price stocks are already an option if you think of it that way.
Yeah,
they're already an option in that they go to zero. That's like an option premium. So yeah, it gets a little kind of silly to be buying protective puts a lot of times on those. I agree.
So check mark. We're above $10. Okay. What is the market cap? Well, the market cap is about $76 billion. Check. This is going to be a high liquid stock, right? It's going to be just fine. The PEG ratio is going to say, hey, we're going to take the earnings and the growth. We're going to put them in one here. So the 5-year expected PEG ratio is 0.19. That is less than 1. So we got a check mark there. Then we say, all right, here's the enterprise value over the EBITDA. We talked about EBITDA. It's kind of like the NOI in real estate. So we have the enterprise value over the EBITDA. And that's if you look at, let's just do a little review here. If you look at NOI and divide that by the value of the property, you get what? You get a cap rate, which is one of the most important things in real estate. Well, if you take, that's the value of the home over the earnings, the income, before we take out the debt, right? The debt payment and stuff like that. So over here, it's very much the same thing, except the only difference here is we're taking the value of the enterprise, right? The value of the enterprise, and we're putting the earnings or the NOI right? The net operating income, or the earnings before all this crap. And that's really a great way to sit. Earnings before a bunch of stuff, right? Yeah. Earnings before a bunch of stuff. So
it sounds a lot better than before interest, taxes, depreciation, and amortization.
Earnings before weird things happen. Yeah, earnings before weird things happen. And if this is less than 10, it's very much like thinking about a cap rate at that point in real estate. So if this is less than 10, and so, Corey, this one happened to be all 4, but does it have to be all 4?
No, I mean, if you saw something that really made you nervous, then obviously you can bypass. But if my PEG ratio, instead of being below 1, is at 1.5, can I still trade that in a bullish manner? Absolutely. So we don't get too carried away with that, but certainly you want to look at some of those things and just feel a level of comfort that this isn't going to be the type of stock that is going to get you into trouble. So.
And because we're doing a put, this is a protected put, they're probably buying a stock that you believe in. You're probably saying, hey, I want to stay in this. Okay, I want to stay in this thing, and I want a little more protection than a stop loss would give me because I really feel strongly about it. So, the longer you're going to hold a stock and plan on running in it, the more important the fundamentals are going to become. The less time you're going to spend in it, then the sovereign fundamentals, the global fundamentals become more important of where things are going on the day. So that's very good stuff. Okay, so that's the first pillar. Pretty easy. 4 things we check at a minimum. And then if you want to go further, you can go further. This is not a fundamental analysis class. It's an options class. But to have that first pillar checked off there with 4, that's pretty good. Okay, technicals, we want to be bullish as well in this strategy. So it's a bullish strategy. We definitely want to have an uptrend. And we do have an uptrend. So on the technical analysis, we might connect the dots here and connect dots here and say that's the trend. And we're having higher swing highs. We haven't quite got a higher swing high, but that happens sometimes. We have not had a lower swing low. So we're going to say the trend is an uptrend. So we can put a check mark on that. Okay, we can check mark that. Okay, we want to find levels of support and resistance. So this is definitely a level of support. This is definitely a level of resistance that became support. And you can see that this is a real stock because they have them. Okay, this is a pretty strong level of peak and valley, a swing. Right here, this is a pretty big one because we got a double top in here. We don't know if this is going to be a double bottom or not. So this is a good candidate possibly for a protective put. We say, gee, we'd really like to hold it, hoping the stock would go up. But boy, we have this double top right here. They've said no here. They've said no here. It's headed back down. They might even let it go further. Maybe at this point is when we say, based on the fundamentals, we want to own the stock. But based on the technicals, we want to protect ourselves. So really catch that in your notes. Gee, based on the fundamentals, we'd really like to own the stock. Based on the technicals, we certainly would like to own the stock. But it's this point right here, this pattern of a double top. See this? This pattern of a double top says, maybe we ought to just put a little protection on this for a little while. And if it goes down, we'll be really glad we did. And if it goes up, we're not going to be devastated that we did, right? I'd rather be on the ground wishing I was in the air than being in the air wishing on the ground when it comes to flight. And I'd rather have a protective put on and not need it than need it and not have a protective put on. Any comments on that?
Yeah, I mean this is a great example of why you might want a protective put, because if it breaks this level, this area right here, it kind of has a pretty good distance to fall potentially, before it can find some support and whatnot. So it's nice to pick up that protection now before that slide occurs. My experience, a lot of times these are basing patterns, and you can kind of see what you pointed out, which is it has the choppiness and then it broke higher. And these trends have a way of winning out most of the time. So this may very well end up not being a double top and just be more of kind of a basing pattern, a high base, or a pennant formation, something along, flag pattern, where it just basically kind of consolidates for a little time. And the really healthy stocks, the strong ones, will do just that. They'll kind of consolidate after a nice gain, and then they'll go and surge and make a whole new one. And this has that potential as well. So good candidate for more upside if we hold, good candidate for having some protection if we don't.
So we're doing our second pillar. We have identified a trend. We've identified our patterns of support, or our little double top pattern. We've labeled the support and the resistance. The volume is high, which means it's high liquidity like that. But there were no gaps in this stock. There were no gaps. So does that mean that we don't do a protective put? No. If there were gaps, it would give me even more reason to do a protective put. This is really a question of, do I want to put a stop loss here and hope it goes up? And if it gaps over, I'm in trouble. But maybe right here we have an earnings date where it might gap. That's always possible. So if this had a gap, boy, it'd make a stronger case for the protective put. This one does not have a gap, but based on the trend, the pattern, where the support and resistance is, it's a high liquid stock. I kind of like to be in it because of the trend, and because of the support and resistance, I'd kind of like to protect it. It doesn't have a gap, but I'm still going to go with the put because it might be coming into earnings or something like that. We might have some uncertainty in the fundamentals like we talked about before. So we don't have to have everything checked every time. In the fundamentals, we checked them all. In this one, we didn't check them all. But we can still feel good about buying a put to protect this position. Okay? Let's start making some decisions. So with a married put, we're going to start here with our cash flow pillar, and we're going to use the Greeks. And this is why I'm congratulating you for taking the time to learn the delta, the theta, and the vega first. So this is going to be important for playing defense and knowing what our position is. Once we have our fundamentals, once we have a technicals, it's time to take a position. So we've taken a position, and maybe we bought this at like, $60 a share or something like that. And now it's sitting here at 64, and we want to protect our gains. We want to protect what we've made, maybe, or at least not lose money in this. If the price goes up, that helps us. Okay, time is against us because it's insurance. The more time we have this protected put on, the more value this protected put will lose, and the more it'll cost us in our gains. In the very same way that time does not help you with your car insurance, time does not help you with your home insurance. As soon as that insurance runs out, you're going to have to buy more insurance. Insurance doesn't last forever. It loses with time. Volatility, though, would make us very happy because we've already bought insurance. It's kind of like this. If you bought flood insurance first, and then you see a hurricane in the Gulf, then you're pretty happy because the value of your insurance has just gone up. It's really cool that you have insurance. So the nastier the market gets, the cooler it is that you bought insurance. The more crazy the whipsaws become and the jerks and up and downs become, the cooler it is that you bought a put and have yourself protected. So it's very important to know the Greeks and to say, this does well if the stock goes up, okay? Time's going to go down no matter what. There's nothing you can do. Time, because we're long the put. Anytime you're long an option, time is not your friend. But anytime you're long an option, volatility is your friend. And so those are the important to understand your position in that third pillar of cash flow.
Yep. And we'll go through that delta, that theta, that vega on every strategy. So this is a great one for your notes. Price going up is good. Time going down is bad. Volatility going up is good. That's a great one for your notes. That's how a protective put works. Those are the elements of those Greeks. A couple of them working for you. A couple of, time specifically decaying would work against you in this strategy.
Yep. So that's how it works every single time. Okay, so you'll remember this. Price is going. If price goes up, it's good. If time decays, that's bad, and time will always decay. And if volatility goes up, it's good. So we bought our long stock. We've got that taken care of. In every option we buy, there are things we want to know. And this is a list of a minimum list of things we should know before we buy an option. So we're going to decide all of them first. So the first thing we're going to decide is the strike price. We're going to say, hey, we're going to look at the strike, how long we want this protection, and how much we're willing to pay. Those are the first three things we're going to decide before we get into all this other stuff. So here's the thing. We're going to do a balancing act, just like you do insurance, between premium and deductible. So you have to make that decision with your health insurance, don't you? You have to think about, do I want a small premium with a higher deductible, or do I want to pay a higher premium and not have a high deductible? And this is a personal preference. How much does it bother you to think, hey, if I go to the doctor, then I'm going to have to pay a lot of money? To me, I don't like paying premiums if I'm not a sick person, right? And so the way I do it is, I guess it's relative, is Corey and I are both cancer survivors. So we have a different view on medical bills. For me, a couple $1,000 medical bill is pretty small in my experience. I really don't care. What I want my insurance to do is help me in something that's devastating. Okay, if it's $1 million,
catastrophic insurance.
If it's $1 million, well, even if it's $250,000 in chemo and radiation and doctor bills and surgeries, even if it's $250,000, boy, I don't want that coming out of my pocket when I'm sick. Okay, when I'm bothered. So I feel the same way that. If I want to put an at the money, you can do it. If I want to do an at the money and say, I don't want to lose one dime, I can do that. There'll be no deductible, right? It'll be right there. We could buy a put at $65 right here. We could put a strike of $65 in, and now the only risk we would have is the premium we pay. That's it. Yep. That would be the only risk we have.
That's the at the money strike.
Yeah, that's
the at the money strike.
And you could do that. But the thing of it is, let's say that the premium for that is like $6. Well, geez, now this thing's got to run a long way to make up that $6 premium. And if it heads up, now I'm breaking even. So I really don't like at the money puts unless I really think it could go huge and I'm really freaking out about risk. I tend to like out of the money puts to say, look, I've got some support right here, okay? And I've got some resistance right down here. And I'm in this stock because I think it could go up. And down here, the insurance is going to be next to nothing. It's going to be cheap. Look, if I put it, and I could do a stop loss too. I could do them both. I could put a stop in here if I wanted and buy the put. Stop loss don't cost anything, right? But that way, if it gapped down over my stop and started to run, I'd have this level of protection here above this major stuff. And if it really goes down, I have my protection. So, I don't mind doing that. I don't mind saying, look, I have a nice upward chance here. Maybe I put in a stop loss really close, but against devastation, I'll buy really cheap insurance. Cheeky. I'll buy really cheap insurance. It's got a high deductible, but stop losses are free. And if I'm not scared of whipsaw, maybe that's what I do. But I like it down here to protect me against devastation. I can live with this. I'll say, dang it, that's too bad. It gapped over my stop loss and I lost a little bit. I'm bullish on it anyway. I like what do you think, Corey?
Yeah, you're looking at it as when you buy the out of the money puts, you're saying, okay, I've got this car and I'm not willing to lose the full value of the car. I'm willing to take the first little bit of loss though. So if it gets a fender bender and it costs me $1,000 to kind of get some bumps out, I'll pay for that. Yeah. But if this car loses $30,000, $40,000, I'm not comfortable with those types of risks. And that's what the out of the money puts are. It's basically saying I'm going to protect this large amount, but the first few dollars of risk in this stock, I'm willing to take those losses. So at 65, we might be buying the 60 strike put, and we'll say, okay, we'll take that first $5, right? The stock's at 65 down to 60. We'll take the losses there. But if it falls anything further than 60, I want to be completely protected. So that out of the money put is going to cost a lot less money than the at the money put, which does a couple of things. Yeah, well, it does a couple of things. It costs less, so it has less risk that way in terms of increasing your cost basis. It also protects you against that catastrophic event, which is really what you're concerned about mostly, So if you really feel like you need that full protection right at the money, you can go after that at the money put. Just understand it's going to be the more expensive choice.
It is. When we talk about time decay, you know that this graph looks like this. So if I only want my insurance for 1 month, here's month 3, month 2, month 1, and 0. I know that I'll have the least amount of time decay, right in here, where I'll have a massive amount of time decay right in here. And then maybe just, a little bit of time decay right in here. So we very much like an expiration of 3 months or more, because if I only want to protect it for a month, maybe over an earnings or over a scary period in the market, or maybe it's just choppy, when I sell my insurance back after I've used it, the majority of that value is still there, and I've only used a little bit. So anytime we're long an option, and time is our enemy, we don't like, time's going to hurt us. Well, let's combat this and say, hey, well, if time's going to hurt me, let's buy more of it. Yeah, it'll cost me a little bit more in premium, but I'll get that money back. I'll get that money refunded, a lot of it. And then if I need my insurance, that's going to be fantastic. That's going to be awesome. And so, and the volatility, if I have volatility helping me before, with a long-term option, it helps me even more. So by going 3 months out, we get a big benefit here and a big benefit here by using more time. Isn't that right, Corey?
That's right. That theta, that time decay, is less in the longer term option. You'll pull up that theta and you'll see that maybe the 3 month option's decaying at a penny a day, whereas the 1 month option is decaying at 10 cents a day. It can be quite a bit different, like you're showing there. Another important point, we touched on the at the money versus the out of the monies. If you look at theta, time decay or theta is highest for at the money options. So it'll kind of have the bell curve where the deep in the monies don't have very much theta and the way out of the monies don't have very much theta, but the at the money options have a lot of theta. So by buying out of the money, by buying more time, we're negating the negative effects of theta. Now, we can't completely wipe them out. We're still experiencing some time decay, right? But by buying 3 months and maybe selling it back to the market when it has 2 months left, we're experiencing less overall time decay than if we bought the 1 month and rode it all the way into expiration.
Just remember, if you're planning on buying your insurance here and selling your insurance after you've used some of it, you've only spent this much on it. But if you buy your insurance here and just let it expire, you're paying a lot for it. You're going to lose a lot of money for it. Okay, and then of course, as we mentioned, if volatility increases, as we did in our lesson on Vega, remember the lesson on Vega? And see, this is where wax on, wax off is so important. Why would you want to know about Vega before you trade the option? Well, if I understand that the further out an option, a 6 month option, is more sensitive to Vega than a 5 month option, and a 7 month option has more sensitive Vega. The further out in time you go, the more this affects you. So by going out in time 3 months, we get to help us here and we get to help us here. That's why I was so angry, Corey, when people were teaching me options without teaching me Greeks first and without understanding how all three of these affect my cash flow. Now, Corey made an interesting statement. He said, what if you could get it for a penny a day? Okay, well, on 100 shares, that's $1 a day, okay? And it's kind of an interesting thing $1 a day. You go back to 2000 and the dot-com crash, and you go back to the subprime meltdown where these things just fell like a rock. You can get a level of protection right here for about $1 a day, right? About $1 a day. And if you have 100 shares, that means if this goes up $1, you make $100. So a $1 move on 100 shares, you can insure that for $1. That's not a bad thing to help you sleep at night. And if you have a 401k, you don't have any of that protection against catastrophic. And so I'm just saying, you ought to look at the value of your home, and you ought to look at the the value of the home. And if it goes up $200, it's 200 to 1, right? It's one half. It's 1/2 of 1%. And so you ought to look at what you spend to insure your home and do that math. How much is your homeowner's insurance? What percentage of it is? And if your if your home goes up, how much value in your home has to go up to cover that insurance? That'd be an interesting exercise for you to do and say, okay, well, which is more likely to burn down, my home or my stock account? And maybe I have a nice, deductible and I use my stop loss stuff, but against catastrophic stuff, for a penny, for a penny a share, $1 a day, you can get that. And you don't have to go far out of the money to get low prices like that. Would you agree?
Yeah, absolutely. The old adage, markets take the stairs up and the elevator down, is very, significant in this example, where risk happens fast. In this scenario, the stock could go down much more rapidly than you're probably anticipating in many cases. When risk happens, it can happen fast. And so, having that protection in place, for $1 a day as an example, if the stock goes up, great. We're still participating on the upside. So instead of making $100, well, we paid the $1 for insurance. Okay, we made 99. It's that sort of idea. We still made that money. Most people don't sit around and complain about the fact that they have to keep buying home insurance and it's costing them money. They just say that's part of the business, right? And so it's the same with trading. When there's risk and when we need to protect against it, this is a great way to get that protection.
Now,
buying out of the money is that catastrophic downside insurance.
If we buy an at the money put at the money and marry the put, our delta will be around 50 cents. That means, and in that first dollar move, we're going to lose 50 cents on on the insurance, right? 50 cents, up or down. Yep. But if we go out of the money, we might be able to get a delta of like maybe 20 cents. That means now if it goes up here, I don't lose near as much. Would you agree with that, Corey?
Yeah, and so maybe show them this net delta effect, because remember, with the stock, you have a 1 delta. So if I buy 100 shares, I have a +1 delta. That means if the stock goes up $1, my gain on 100 shares is $100, right? I have a full 1 delta. So I participate
the stock,
penny for penny with the stock.
Yeah, so we'll put that in red. The stock makes $100, right? That's how much it would make if it went up. But my delta, if I had a 50 delta, so let's just put a 50 delta here, right? My insurance since it's going up and it's a put, my insurance would lose
lose 50 cents.
Lose the 50 cents.
At the money. Right? Remember, at the money options normally trade at 50 delta. So what's your net delta in that case? Well, we have a 1 delta minus 50 delta would give us a net delta of 50 cents.
Of 50.
So
yeah. I'll just put this. So instead of change this and make it $1, would be a better way to explain it.
Yeah.
So if I go up, I'm at 55 to 56, I get $1, but I lose 50 cents on my insurance, right?
However, think of it as every share. Every share of the stock is making $1, but every share of the put is losing 50 cents. So the net delta was 50. Now, if you bought out of the money at a 20 delta. So now your protection is creating less of a net delta impact. So we still have the 1 delta in the stock, right? Still have that. But now we subtract only the 20 delta, because that's buying an out of the money put. It's going to cost less money. It's going to have a lower delta. Now our net delta is 80 cents. So if that stock goes up after buying the put protection, if we bought the at the money, we only made 50 cents or $50 total on 100 shares. If we bought the out of the money, we made 80 cents or $80 on our 100 shares, because we made $100 in the stock in either situation. If we bought the at the money put, they lost $50. If we bought the out of the money put, it lost $20. So notice your net delta there is what he's explaining. And that's a great example.
I'll tell you
why the out of the money can be a good situation that way, if you're right and the stock's still going to go higher.
You know, when we decided to create this course, I was really, really nervous, Corey, because I thought, you know, to teach this the right way, people want to get to the strategies. They really do. To show me how to make the money. And I just said, look, I'm not going to do it that way. I'm going to do the first lesson. The first lessons I'm going to do, like in the first 4 or 5, we're going to talk about delta, theta, and because it is this stuff right here that affects your cash flow position. And I'm so angry with my early instructors that taught me how to do that. And I meet thousands of people that are using options that do not understand how delta, theta, and vega affect what's going on. And this is a huge difference right here. It's a huge difference to understand. So we like delta instead of a at the money, instead of let's just put it here, an at the money of say 50. We're going to say we'd like maybe an out of the money at like maybe 20 delta. And instead of having a strike that is at the money, well, let me get my colors consistent. At the money, I might want a strike that is out of the money. And instead of an expiration that is 1 month away, I'd like an expiration that is 3 months away. Instead of having a theta that might be like, 1 month might be like, 10 cents a day, I want insurance that's going to decay at maybe a penny or 2 pennies a day. Instead of paying a premium that might be like, I don't know, like $5, I might want a premium that is $1 or something like that by going out of the money. Vega now, instead of having a vega that is small at one, I should put that in green to make that consistent. I'll figure out which one green is. Give me a chance. Instead of having a vega that is very, very small by doing a 1 month, I want a vega that is very, very big by doing a 3 months. So now we've talked about how we want to do strike, expiration, and premium, and we've talked about how the delta, theta, and the vega will affect this trade. Now, I know we've taken a long time in this lesson, and I promise you that this will become so fast. Remember, we only talked about 6 things. Well, think about how at first you had maybe a 6-digit number to remember, but after a while it becomes old hat. If you have 6 kids, you can remember all their names pretty easily. Well, maybe you can. I've only got 2, so Corey, you're ahead of me in that department. But now we've taken care of it. You
might call them by the wrong name, but you'll get it right eventually.
Without understanding this in the cash flow pillar, we make mistakes in what strike to buy. We make mistakes in what expiration to choose, how many months, and we can make mistakes in what premium we pay, not understanding how the delta and the theta and the vega affect the cash flow position of long stop with a put. Okay, option volume, we check that, and these 2, we just use our regular rules, which means we want liquid. If you're in the morning, this is going to be low, so check this one, because in the morning they haven't had a chance to trade anything. So another way you can tell how the volume is, other than here, is the spread. If you have very narrow spreads, then you can rest assured that you have the liquidity you need. If you have very wide spread, then getting in and out and selling your insurance back can be tough. And then the last thing we'll do is look at probability, and you get that from the delta. In other words, what is the probability that this will hit that far? Hey, you know what? If you're only paying a penny a day, then it might be, like a 80% chance that it never gets there. And that's good for insurance. But if there's a 20% chance it can get there, if there's a 20% probability to get there, probably we're spending that penny to get that protection. So anything you want to say on that?
Yeah, that probability is just what you've shown. So if you bought the at the money, there's about a 50 delta. That means there's about a 50% chance that you're going to need that insurance. If you buy out of the money, it's about 20 delta. So there's about a 20% chance that it'll fall to that level.
Well, no,
we are buying less.
There's an 80% chance it won't, correct? If
it won't. Yeah. Or a 20% chance, that we'll end up using that insurance, that it'll actually fall below that level. So we're not buying a put protection that we normally are going to have to use. The same way that you buy car insurance, you're probably not expecting to use that very often, but it comes in handy when you need it. And so same kind of concept here, where if you're buying out of the money, you're saying, look, I'm not buying the type of insurance that I need to use constantly. I'm buying the type of insurance that I'm going to be glad I have it if I ever need to use it.
Yeah, this 20 here, means it's only a 20% chance it'll be here or lower. Okay, this 80% chance means it's an 80% chance it'll be here or higher. So, but if it's a 20% chance it can get there, my gosh, let's cough up the money. Let's pay the insurance, okay? So again, these are the things we want to know every single time. We're going to do this in every single trade. What is the position? What is the strike expiration premium? What our Greeks are going to be? Make sure we have good liquidity right here. And then, what is the probability of success or needing the protection? If we're selling it, hey, it'd be the opposite. But we'll get to that in a different video, okay? All right, so let's look at our option chain, and let's look at our guidelines and review them. So we buy this stock. We really liked this one better. We like doing it below the support, 3 months with a low delta, which means low premium. We're not going to spend all of our money on insurance. We're going to buy cement truck insurance. We're going to buy fatality insurance. We're going to buy catastrophe insurance right there. So pretty good. So let's look at some numbers now of this actual stock. So we saw the stock was trading at 65. So this is the at the money put. Yeah, this is the at the money put. Let's just put that in blue for fun. So this is the at the money put. And so we can see the bid and the ask. This is going to cost us about a premium. If we bought this one, it would be if we bought at the money, it costs us about $3.53 if we bought it at the money. The delta on this right here is about 50. It's 48.4. So we would lose 48 cents in a dollar move up, and we'd gain 40 cents in a dollar move down, or 48 cents. The theta is pretty cheap. The theta is, 1.4 cents a day?
Yeah, so
right here, because this is a three. This is
1.5 cents of time decay daily.
This is a 3-month option, so no matter what one we buy, we're going to have good time decay, right? Because we're going to buy 3 months or more. That's going to give us very, very, very low time decay of just 1.4 pennies a day. So, 3 cents on 2 days, however you want to call it. So we're only at 0.14 cents a day, 1.4 pennies a day. And then the Vega is also very, very small, okay? 139, so about 13 there. And our option volume is actually very, very low. So that concerns us because we want to be in liquid. We're very concerned. And I say, Corey, wait a minute. This is, we got plenty of open interest here, but I got no freaking volume. What the heck's going on? Do I really want to buy this put? Well, yeah, I do, because what's really narrow right here?
Yeah, the bid-ask spreads are close together. That means there's plenty of buyers and sellers. Must just be early in the trading session in all likelihood.
If I get a spread, if I can get in for $3.53, I can probably get out for $3.52 if I turn around and hit the button right away. So there's not a lot of spread risk right here.
Plenty liquid.
The open interest is fine, and my probability of using this insurance is about is about 48% chance.
48% probable.
Because that's a good way to do it, is look at the delta again. Say it's about a 48% chance I'd need it. So I feel pretty good that, if it's half a chance I'd need it, then great to have it. But this is expensive. My net delta cost is big. If it goes the wrong way, I'm losing a lot of insurance when it goes the wrong way because they went up, probably don't need it as much. And this is okay. I'm pretty happy here with my 3-month option. And this is pretty good, but I do not like these other numbers, Corey. I don't like them.
Yeah.
So let's do this. Let's go down just a couple of strikes.
Go out of the money.
Yeah, out of the money.
60 strike put.
Let's go 2 strikes out of the money, okay? And so that'll be about $5. So my deductible is going to be $5. So here's my balancing act. My deductible, if I bought it at 65 and it falls to 60, or maybe I bought it at 60 and it's up to 65 now. Either way, my deductible is now $5. But
you're on the hook. You're on the hook for those first $5 of losses because remember, if we buy the 60 strike put, we're buying the ability to sell at 60. We have the right to sell at the strike price. But the stock's worth 65 right now, so we're going to lose that first 5 without protection. But we're completely protected below 60.
But people have 8% drops in the market all the time, and in their 401k it can drop 8%. Okay, that doesn't freak anybody out.
Sure.
It's when your 401k is cut in freaking half because of a market crash that freaks you out. So yeah, even though I might have an 8% drop before this helps me, I'll tell you what, I'm looking at the premium on this thing, and I'm getting this for $1.63. That's a lot better price to get it for $1.63. And that's only 1.3 cents a day, so I still get my good delta. So my strike now, I'm going to go to 60. My expiration is still 3 months. My premium now is only $1.63. That's about half of what I was spending before, a little better than that. And my delta is 26. So now if it moves up $1, I don't lose 50 cents of that dollar. I only lose 26 cents of that dollar. So I really like that idea. My theta is basically a penny a day, and my vega is about not quite
almost
as good.
12 cents, 11 cents.
But instead of being 14, it's about 12. We'll take it to 12. That's not too bad. My option volume is not as good, but again, we have a very tight spread. So even though I don't have the volume, I have the spread. That's pretty good.
And the open interest is actually better in that strike.
Better open interest at that strike. And my probability of using this insurance is about 27%. We'll round it up. About 27% chance. Not quite 30% that I'd need it. And that I'd start to benefit from it at that point. So I like this one better. So let's write. Did you write all these down, Corey?
Yep. Okay. So we paid $163 for that put. Yep, and we've got some numbers there to work with. Okay, so, and we might have bought the stock at 60. We might say we're buying it now at 65 because that's what the price is on the chart. When it's going at 65, about 65 bucks. And so now we got to figure out our risk management and the 4th pillar. Now, this has taken a long time to do. Well, that's because we're doing it. I'd rather be accused of being too detailed and too in-depth. I promise to make the most in-depth, comprehensive, awesome deal. So we're going to do the risk management, okay? Now, remember that price going up helps us. Time decaying hurts us. Volatility is a happy thing. So what we want to do in risk management is we're going to get 3 crystal balls right here. There's crystal ball number 1. There's crystal ball number 2. And there's crystal ball number 3. And we're going to look into the future. And I'm going to predict 3 futures. Can I predict the future? Yes, I can. In this crystal ball, I'm going to predict that the price goes up and keeps us happy.
in this crystal ball, I'm going to predict that the price goes down and makes us sad. And in this crystal ball, I'm going to predict that the thing just goes stagnant and it just stays neutral. We'll just put an N for neutral right there. And so those are my 3 predictions. And guess what? I'm going to be right with one of them. So I'm going to make a plan for this one. And I'm going to be okay there. And then I'm going to make a plan for this one. And then we're going to make a plan for this one. And now no matter what happens, we have a plan. Now this is your specialty, Corey. This is the most important pillar. And so we're going to have a plan for all 3. We know that if the price goes up, we're going to be happy. So we want to have our first plan if the price falls, right? That's the first plan we want to make. So the first plan we're going to make right here is we're going to talk about a plan that if the price falls, then we're going to make a plan. Now, time, I'm going to make a prediction with the time part. The time is going to go down, okay? The time is going to decay. So that's my prediction on, so my delta predictions are here. My theta predictions are here. My volatility prediction, let's get this. My volatility prediction is it could go up or it could go down. That's my volatility prediction. And so we're going to make a plan for each of these. What if the stock goes up? Awesome. What's my plan? What if the stock goes down? Fantastic. What's my plan? What if the stock stays the same? What's my plan? What if the time decays? Well, that's definitely going to happen, so this one's easy. What if the volatility goes up? And what if the volatility goes down? Okay, so in this trade, we're going to ask every one of these questions so we have a plan of what to do on this. Talk about risk management.
Perfect. Yeah, so let's go through the first one. What if the price falls? So stocks at trading right around 65 right now. Let's say this thing goes down to 55 or something like that, takes this big drop. Now, where are we at in our trade? Well, we're glad we have that insurance, right? We were insured and protected from $60 on down. That was our strike price. So kind of in the middle of that decline is where our protection kicked in at about $60 with it down at 55. There's a couple of things you can do here. One that makes a lot of sense is to simply sell the put. So you're getting towards expiration and the price falls. We have that insurance. We're selling that put for a nice profit, right? We paid only a dollar or so, and now it's 5 points in the money. So what we paid 100 and some odd change for, we can now sell it back to the market for $500 or so dollars. So you can lock in a gain on that protection. You can sell that insurance back to the market. That's a good thing.
So we're bummed.
Now, the bad news.
So we're bummed, just like if you wrecked your car. You're really bummed that you wrecked your car, but you're really happy that the insurance company wrote you a check.
Yep. And so you're glad you have that insurance, and the insurance paid off. You get a check back, kind of like from the insurance company. You get to sell that put back to the market and lock in a profit. The downside, though, is the net effect is you have a loss on your hands because it didn't insure you against those first losses. Plus, you had to pay some money for the put. So what do you do from here? Well, it's gone against you. You're underwater. You'd evaluate this situation. Do you want the stock anymore? If you don't want the stock, you can simply dump the stock, right? We could sell the shares, be done with this trade. At least we get out at a better overall value because we locked in those profits from the puts. So notice we're in a better situation here than if we had just ridden the stock down and then sold it. At least we made money on the puts. Correct. So we can dump our stock, move on to something else if we feel like the trend has changed.
Yeah, and I will tell you this. I will tell you this.
Yeah.
If the stock falls to here, in the first dollar we make 20 cents. Our put goes by 20 cents. When it goes to here, it goes to here, it goes to here. It gets more and more valuable the closer to the money that it gets, right, Corey? It gets more.
Yeah,
it accelerates in value.
Exactly.
Yeah, the further it goes, the faster the value goes up. So let's say, though, that I see, maybe a support zone in here. And I say, hey, this would be a great time to buy this because the fundamentals are still strong. I take this profit. And maybe I what?
And then this is where we would buy by rolling out, and you could, in other words, replace the insurance by rolling out and rolling down.
That's
so
true.
You could do both of those.
I'm getting ahead of myself. You're right. Let's do
okay.
it. No, you're teaching the right way. So if the price falls, we sell. I'm getting ahead. I'm going too fast.
I didn't realize you were going to buy the dip, and we'll get there.
I was going right to here, and we'll get there. So, okay, if the price falls, we're going to sell our put for cash.
So we sell the put back to the market. We lock in that nice profit, right? Now we have some choices. So we're down at support, and we think it's going to bounce. But do we want to just sit there and hold the stock with the risk that it could keep falling? Maybe it breaks this support and so forth. So what we can do, remember, we're running out of time, or we want to sell that first option back. We now hold the stock. This is where a roll out and a roll down comes into play. What does rolling out mean? It means that if we own hypothetically, let's say we own a July option.
Well, let's
we're
say
selling the July.
We had the December. We had the
Decembers.
It was 100 days out. If we had the Decembers.
If we're dumping the Decembers back to the market, rolling out means we're buying a later expiration. So we might be buying the February or the March in the next year, right? We're selling the earlier expiration back to the market and buying a later dated. That's what rolling out means. Closing one and going out in time. That's where the term roll out. So we're replacing, that's rolling. We're replacing our current put by going out further in time. What we're also doing is rolling down in strike price. Remember that we had the put protection at a $60 strike price. Now that we sell it back, we might buy the 45 strike put. Notice the 45 strike put is a lower strike price than where our previous put was, which was a $60 strike price. What does that do for us?
Gets us cheap insurance again.
Cheaper insurance. We sold back the really expensive option to the market that had a short-term expiration that was going to decay faster and all of those factors. We can sell that back to the market, get that big premium, take a smaller portion of that, and buy new insurance. So we've rolled out and given ourselves a couple of extra months of time. We've rolled down in strike price and given ourselves more protection at a lower level, but more protection a couple months out. So we've rolled down and out in this adjustment.
Now, another thing you could do is if you felt like an earnings announcement had passed and you felt like you didn't want to buy insurance again, that it was really low now, it's much less money at risk. You know, you got $15 less risk times 100 shares, $1,500 less. You really feel confident that it's going to do this. You could take the money you got for the put, and then you could buy the dip. You could do that too, right, yep. Corey? You could do that,
Absolutely.
and now you'd have more shares, so you could buy more shares. If you decide to hold the stock, you could add to your pile. You could buy more shares, and now you have, as this goes back up, you have a larger position. So when you get back to this $65 price, you've got a lot more money because you have a bigger position, and it paid you, it compensated you a little bit as you came down, right? You didn't really get making a lot until it went in the money, but it did compensate you when it down, get more valuable, and because you had plenty of time, right? You had 3 months. It only took a month to get there, and now we're like, geez, we made all this money on the put. Let's just use it to buy more stock, and when we get up here, we're even richer. Because we're at support. It's still a good, strong, fundamental company. If it wasn't a good, strong, fundamental company, you wouldn't hold the stock. You would sell your put for the cash, sell your stock, and go buy something else different. Is the other option.
Here's the brilliance of that. From our balance sheet, we didn't have to spend any extra money.
Yeah.
Our insurance policy went up in value, and we sold it back to the market, getting all that premium paid back to us for the insurance contract. and then turned it right back into the stock at a lower price or better value in the stock. So we didn't have to go to our cash and say, hey, I need more money to buy more stock. It was actually our protection that made us the money that we can then now reinvest right back into the stock.
So our stock lost value, but our put gained value because of the insurance. And we took that. When we sell this put, we have cash. We can add more stock. So our asset column gets bigger. We have more shares. It's like being able to put an addition on the home after the fire happened. Yeah, you lost a little money in the deductible, but they did pay you some, and you didn't buy a whole new house, but you put on that garage you always wanted to with that insurance money, and that was nice. That type of a thing, right, Corey?
Yep, exactly right. So it actually paid you the money, and you didn't have to go to your cash to buy more shares. You actually had the money from the put, which is really just a very compelling way to do it. When you think about if you're going to buy the dip, you're using the insurance and not your capital.
Exactly.
You're using the capital from the profit of the put. Very cool.
So if the price falls, we're gonna sell the put for profit. We'll probably roll out and roll down. Or instead of rolling out and down, we could buy the dip. We could use that money to buy the dip. And buying the dip, whether you decide to do A or whether you decide to do B in that would depend on what? 4 pillars. If you still have strong fundamental analysis and you still have strong technical analysis, well, by golly, buy that, stay in that thing, and even buy that dip. Or if it's still kind of iffy, well, stay in it, hold your shares, but roll down and roll out and use the money that you got for that put to buy another put, to buy more insurance. So on the sale of the put, you can either buy more stock or you can re-up your insurance. Either way. Does that make sense?
Perfect.
Yeah. Okay. What if the price...
All right. Price rises.
Wow, what if the price rises? Well, that would be awesome if it that would be fantastic if it rises.
And this one's really, really pretty simple in that was the objective. That this was always a bullish trade. We were always bullish on the stock. We bought the protection in case. We thought there were some short-term risks. So what's happening here? Price going up. That's very good for us. Our stock is gaining all that value. Now, the put option
loses value.
Will lose value. We can sell it back to the market before expiration if we feel like, hey, we don't need this insurance anymore. It's way down there. Let's sell it back to the market. Let's get back what we can for it. If there's not really much of any value, say the stock jumped up sharply and that put's trading down there at 5 cents a contract. Well, at that point, it's probably not worth selling back to the market, right? It doesn't have any real value in it. We could just simply let it expire, and that's an okay situation because we're losing the $100 or so that we paid for the put, but we're making that in this example from 65 up to 70. We're making $100 in the stock or $500 in the stock. If losing a little on the insurance is fine.
If you compare this to owning a home, that's the ideal scenario. Your home would appreciate in value. It didn't start on fire. You didn't use your insurance, but you don't get a refund on your home insurance each month if it doesn't burn down, right? If you didn't use it. So the ideal scenario of insurance is just what we said, that the price goes up, the time hurts you just like it does in your homeowner's insurance, the appreciation of your home justified or overwhelmed or at least helped offset the cost you pay for insurance. It's funny, a lot of people will buy a home and sell it and say, yeah, I bought my home for this and 5 years ago and I sold it for that and I made X. No, you didn't. Subtract the insurance that you paid for it, all that interest that you paid for it. That's really, you look at all that amortization that went on. How much did you actually pay each month for taxes, insurance? That you got to deduct all that.
Those are expenses.
Yeah, exactly. So it's the same thing. The time. If it goes up, the volatility is the volatility. It's probably the least important in this trade. If it goes up, time's going to overwhelm it anyway. And so you sell what's in it. Now, if you wanted
there's one other scenario exactly. So as the stock's gone up, we might now say, hey, we need more insurance, okay? It's run away from our insurance. It's up here at 70. So we could roll up and roll out would be a common situation. So rolling out in time means, well, we had the December put option. Now we're going to go out and buy a February or something like that. We'll roll out in time. And we're going to roll up the strike price because before we bought the 60 strike put, now we're going to go up there and buy the 65 or the 66 or something like that, a higher strike put. So we're buying further out in time. That's rolling out the insurance. We're buying higher strike on the protection. So we're rolling up our strike price. They call that a roll up and roll out.
Yep. So very simple if you felt. And then another thing you could do is if you felt, you could sell your stock too for a profit. You can always sell the stock. That's going to be in every single one. You want to find somewhere else to go, you can always sell the stock and go. So pretty easy. So if the price rises, we're very happy. That's what we wanted to happen. We can sell the little money that's left in the put and use it towards another expense to buy another protected put if we feel we need it. And we roll out, same rules. We go out a little further in time and we go, this is still out of the money. It's still out of the money. It's not a $70 at the money. This would be the at the money. This is out of the money now, right? This is at the money. This is out of the money. And this is the one we usually want to go with. So we have a plan if the price falls. We have a plan if the price rises. Now, what is our plan if this thing just meanders like this? What if this thing just kind of becomes a stock in a box? Well, time hurts us.
So in that case, that's kind of where there's a lack of volatility. So price didn't help us, volatility didn't help us, but time is still going to hurt us in that situation. Yeah. So that stock going sideways means our stock's not gaining or losing, but we're still going to have some deterioration in that protective put. So we could sell that put back, get back what's value left is still remaining in it, and kind of feeling like, hey, stock is range bound. We don't need that protection.
And we probably want to have 2 months left, right? We want to have 2 months left. We don't want to wait. We want to draw a line in the sand and say, okay, here's 1 month. If this thing doesn't go anywhere in a month, we know that our time decay graph only loses a little in that first month, that third one, second one, first one. So in this first month, we want to sell that put with 2 months left because we still have most of the premium in there. We're still at about the same strike. We're spending a penny a day on it, 1.4 pennies a day on it. It's just not going to cost us that much in a $6,500 position. Let's sell the put, but don't sell it here. Don't wait. Don't wait until it meanders clear to here, where the option expires. Don't do that. Sell it here. This is called a time stop, is what it's called. It's called a time stop. We have price stops and targets, but we need a time stop on that. So we're going to sell that put with time left, right, Corey?
Absolutely. And what you could do, sell that put with time left. Now you could roll it out. And you probably wouldn't roll up and you probably wouldn't roll down, but you might roll out and you might say, okay, I'm getting to a point where my put is going to have a higher theta. So let's go ahead and dump the December and that's going to have the higher theta, go to a February and get a lower theta, get less time decay. So if you felt like the insurance was still needed, you may still go ahead and decide that I want to go out in time so that I have less of that theta effect against my option.
So here's the original one we bought with 3, 2, 1. We find another strike out here, and now this one's 3, 2, 1, and we just roll forward. We roll out. We just extend this time decay graph out to where we're still only paying the smaller amount. And if it happened again, we're only going to be we're just going to keep buying that and paying the smaller amount. And, if it's stagnant like that, well, another thing you want to consider is, okay, that's fine, but if you're holding that, guess what's happening right here a lot of the time?
Dividend.
You're getting a dividend out of that, right? You're getting a dividend out of that.
You gave a little hint as to what this stock was. This particular stock pays, I think, about a 4% dividend yield. So, you're going to pick up something. along the way.
Yep.
And remember, our theta number on this was about a penny a day. So if you hold that for 30 days from month 3 to month 2, you're talking about $30 in decay in value at that theta. So, insuring $6,500 worth of stock and having decay in your insurance of about $30, not the end of the world. Probably a pretty good use of your funds.
Yeah, and remember, if this stock goes up $5, now it's a $7,000 stock, right? And yet, if it falls down $15, well, you had your insurance in place, right? So it's pretty nice. So we've got what to do if the price falls. We have what to do if the price rises, and what to do if the price stagnant. Now, here's what's cool. We didn't like the price falling, but down here we didn't like the price falling, and we were kind of sad at that scenario. If the price though had taken a dive like this, we'd be jacked up happy, freaking jacked up happy that we had insurance. If all of a sudden it's down here and you only took a $5 loss instead of a $15 loss, you are jacked up happy here. So as I look in my crystal ball, I say, all right, if it goes down, I will be a little sad. But if it goes down a lot, I'll be really, really happy with my plan. And I can live with this one. This isn't devastating. This isn't my son getting hit by, a car. This isn't my wife getting stricken with a disease. This is a drop of 8% in a stock. And maybe I had a stop loss on it right here, when I got out with a stop loss. Stop losses are free, right? And just in case of catastrophe, I had that insurance on. I'm stoked. So if it goes down big time, right? If it goes down big time, I'm happy in that crystal ball. Okay. If it goes down big time. Now, let's say that it goes down, I should match it with the right colors here, right? So if it goes down big time, well, I guess it doesn't matter. I can put it in green. If it goes down big time, I'm going to be happy if it goes down. If it's stagnant, well, I'm not going to be thrilled, but I'm not going to be devastated. So, anytime I'm not getting my butt kicked in the market, I'm happy. And if it goes up, I'm happy. So the reason to have a plan for all three is at the end of the day, and this is what makes you feel good about being a trader if you have good risk management. You say, look, at the end of the day, I'm prepared for all three scenarios. Any one of the three that happens isn't going to end my life. I certainly have more control over this situation with a protected put than I do a 401k. This, of course, would be my favorite to have happen. This would be my next favorite. This would be my least favorite. But at least I have a plan, and I'm okay with each plan. Comments, Corey?
Yeah, that's exactly it, is having a plan in place for how you're going to handle each one to best take care of your price, your time, and your volatility. I mean, that's option trading, and that's what we're emphasizing. How important are these things to understand before you put on your trades and before you get into strategies? It's critical. So that's why we have a plan in place for each of these.
So if the price falls, we can roll out and we can roll down, or we can buy the dip if the price falls. Okay. If the price rises, we can roll out and we can roll up, right? If the price stays stagnant, we can roll out. Okay.
Yep.
And those are the basics. That would be our basic plan for those. Now, what if time runs out? Well, we're not going to let that happen. We're going to have a time stop. Correct? We're going to have a time stop.
Yep.
And what we're going to do when time starts to run out is we're going to at least roll out, and depending on where these went will depend on whether we roll up or down. But we're definitely going to roll out or sell the stock and leave. Okay, so that's easy. And then if volatility falls down, that's not the greatest thing for us. But in this particular trade, this is not like a short strangle or an inverted long strangle. It's not a long strangle. So volatility is not going to be as big a deal. And you saw that the volatility was like 13, Corey. It wasn't a big one, right?
Yeah. Yeah, and basically that Vega number is telling you for every 1% move in volatility, you can expect about whatever the Vega is, which was about 13 cents of value change in your option. So volatility increasing means that people are getting more nervous and willing to pay more for options and premiums. That inflating of the premium is good for us. But in this case, volatility falling means people are saying, look, I'm going to pay less and less for insurance. I just don't think there's a lot of risks here. And since we're sitting there holding the insurance contract, the less that people are willing to pay for it, the more it's kind of eroding. So we don't want volatility to drop dramatically. But here's the kind of good news about that. Volatility tends to move opposite to stock prices as a general rule. So volatility is more likely to fall if the stock is rising. So if the stock's going up, isn't that what we want? We're profiting from delta. Delta is going to outpace the Vega decline. Volatility is more likely to rise, as we see down below, if the stock is falling, and that's when we need the protection. And the good news is volatility going up means our put's becoming even more valuable. So the point I'm making is if volatility is falling, it's more likely that the stock is rising than that the stock is falling sharply. It's very, very uncommon that the stock would be falling and volatility would be falling as well. They tend to move in opposite directions. So if price is going up and volatility is going down, we can handle that. It's less likely that volatility would fall while the stock falls.
I'm not going to take any action because of volatility most likely on these trades. That's going to take care of itself in these right here. I think that's the best way to look at it. Now, so why even have it up here? Well, you're going to see later that if you're in a short strangle, and all of a sudden that volatility rises, even if the price doesn't very much, you could be in a world of hurt right there. So
yeah, you'll need to take action in other trades around volatility.
So boom, 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 boom. If a person asks these questions, what if, you're going to be in a lot better shape. You'll be in a lot of shape. We promise you to show you how to do this in a trading journal every single time. I'm going to give you mouse control, Corey. I never gave you mouse control, so let's give you mouse control. And let's go ahead and start with stock, and let's enter that trade. Let's make this nice and big so we can see what's going on, and let's enter the trade. Go ahead. It's all yours.
Let's do it. Okay. So here we're buying 100 shares, and we can do this in two separate orders, right? So we could do the stock and do the put as separate transactions on this trade journal, or we can combine them together. So we're buying the stock at about 64.97, and we would have a target in mind. Maybe we're targeting the stock to go up. I think
we had 72 is what we were saying.
72, okay. And then we have a stop idea, where our downside risk is. And, in this case, we're going to have a put protection. So maybe we'll call it 60, something like that.
And and here's the thing, a little detail. If you were buying cement truck insurance, your put would be at 60, meaning that if you got hit by a cement truck, you'd be covered if it went to 30, right, or 40 or 50. But there's nothing that says you couldn't put a stop in at 62 or at 63 as long as you weren't scared of the whipsaw, as long as you weren't scared of having it fall. Because stops are free to put in. And then if you got stopped out, then you'd also sell your insurance back and leave the stock. You could do that as well, just as a note.
So now let's show this kind of a comparison. It'll get a little bit more expensive because instead of just buying the stock, remember the stock costs $64.97, we're buying the put along with it. And that 60 strike put was going for $1.63. So if we add those two numbers together, That's our total cost basis. And our total cost basis in this case is $64.97 for the shares, plus we have to add the cost of the put, which was about $1.63. So those are the two prices we're adding together. And that comes out to $66.60. Let me repeat how I did that. Simply the price that we paid for the stock, $64.97, plus the price that we paid for the put option. And the put premium was going for $1.63. So those two numbers is our total net debit, our total cost of investment. Well, if we have our target at 72, now a couple of advantages, couple of disadvantages to buying the put protection, which we'll talk about. And we know we have our protection at 60, meaning if this stock falls, it doesn't matter how low it goes, this is offering better protection because it's an insurance contract at 60. Whereas if we put a stop loss at 60, it's not perfect protection. It's designed to get you out if the stock falls to 60. But if that stock gaps down to 55, you're getting out at 55 on the next day that it opens, not at your ideal price of 60. So this put insurance offers complete protection. So as we look over here at the numbers, you'll notice risk to reward and risk and so on. Our risk increased a little bit, didn't it? We went from $497 if we just did the stock trade by itself with a stop loss to now we have $660 at risk. And that's that additional cost of the put. That's why our risk went up. But our reward goes down because we paid for that put. So the difference is if we had just traded the stock, could you make more just trading the stock? Absolutely. 703. Could you make still a very good sum having the put protection and owning the stock? Sure.
Absolutely.
Only the cost of the put less. And let me make a couple more kind of important points about this. What if this stock had gone down to 60 and then rebounded?
Yeah.
Remember, we're buying 3 months worth of insurance. So with this stock at 65, could it dip down, hit the stop loss, and then go all the way up to your target at 72?
You bet it
Sure,
could.
I've seen it happen plenty of times. If you just traded the stock, you're out, and you have a loss of $497. If you have the protective put, when it traded down to 60, nothing happens, right? You just have that insurance contract. You're not stopped out of the trade. You have complete insurance. As the stock recovers and goes back to 72, we now have the profit instead of any losses. So, it's kind of important to keep that in mind, that this insurance gives you time and it's not a hard stop. It doesn't kick you out prematurely. You get to manage the trade and you can sit in it and you can roll it out and you can manage that. Whereas if you just have an order to get out, it doesn't guarantee your price.
Right.
If it's a stock order, a stop loss, doesn't guarantee you price like the option does, and it might be triggered prematurely, and then you're not able to participate and achieve that gain. So some things to keep in mind there.
For sure. I'd take a sip of water. Fantastic. Absolutely fantastic. The other way you could do this is you could certainly put the option in, but I like this method better because it combines the two and it pretty much gives you the same numbers. So hopefully you're able to follow that. And if not, review it. And if not, review it another month after you've practiced a few times. We're going to talk about practice here in a minute as we go. Anything more you want to say on this?
No, I think this is good. And I like to combine them the way I use the journal because that is your net debit.
Yeah.
If you buy the stock and you buy the put, that $66.60 is your total cost basis. And so you can work off of your target and where your put protection strike price is and know where your basic risk and reward and some of those numbers lie. So
yep. So
I like to do it that way.
So that's really, really cool stuff. Let's get more detailed now. So when you trade, we're on the home stretch. When you trade, let's make this in Ether mode so we can have it. I might take it back out. when we trade, we always want to have an idea of what can happen. So we know we want to know a few things right here, and this is in the trading journal. If we look back
and
here,
I've got those numbers. If you want to jot them down.
I've jotted down 660 for our risk, and I've got 540
reward
as our reward. Okay, and another thing we want is we want to get what's called a break even, right, Corey?
Yeah, and the break even in this trade is our total net debit or price. So 66.60 becomes the break-even price. That is where we, at expiration, if we were at 66.60, we would completely break even in the trade.
So we're going to write these down, okay? So we want to know our break-even, which is $66.60. Our profit, and that's the stock price, okay? That's the price of the stock. So if the stock stays,
stock price break even.
If the stock stays at, what do we say, 66? Is it 66.60? So that's right about, here's 67, here's 66, here's 68. So about right there, about 66.60. So that, we're just going to mark that right there. Okay, that's it. Now our target profit was going to be
$572.
Yeah, that's $540 in profit. Isn't that right?
Yep.
So
So plus 540 would be your target profit, exactly.
And that's at 72. Okay. So target profit. So let's just put in the money. $540 if it hits $72, right? And that's what we think it can hit. And the likelihood of that happening, we could look at the delta. We could go back and look at it and take a guess at it. It's probably up there quite a bit. I mean, it's probably a long shot to get there. But according to the chart, we say it's possible, but it's not probable. How would you get that?
Yeah, it's kind of like the put that we bought. The put that we bought has a 20 some odd delta, which means there's only about a 20% chance. Well, that would have a similar kind of, the delta would be pretty low because the stock's at 65. Are they going to expect it to be at 72? No, they'll give that a lower probability.
There'll be a 20% chance. It was a little higher. It was about 23, I believe, or 29, I think it was. So it's probably pretty close, or somewhere in there.
Something like that.
And our target loss, our max loss,
660.
Our max loss
is 660.
660, and that's if it goes all the way to zero. That's if the price goes to zero. That's it. Okay. We'll talk about what our target loss here is in just a second. Okay, in just a second.
Yep.
Then our max profit is infinite because this stock could go up forever and outweigh the insurance. So there we have 5 numbers that you want to have every time. It's actually 7. The max profit, the target profit and the chance it could get there, your break-even point, the target loss, which we'll do in a minute, and a 20% chance of getting there, and then 660. And I'm going to show you why we have left this blank right here. I'm going to show you why, because of time decay. Time decay is the difference. So we're going to start here, and we know that the most we can lose is 660. So we're going to come down here losing 200, 400, 600, 700, and back it off at 660. You do not need software to do a risk graph. You can draw it on a napkin if you want. Okay.
Yep.
We know that the strike price of our call is at $60. So we get to make a dot right there. So the first part of the risk graph is really, really easy. We know that the most we could ever lose in this stock is $660, even if it went all the way out here to zero. That's the most we could lose. Isn't that right, Corey?
Perfect.
Okay, now let's talk about this. We bought, what do we say we bought the stock at? 64, but
64.97.
So almost 65, but we paid another $1.63
for the put.
So we're going to be right here at this break-even point.
66.60.
So our break-even point at zero is at $66.60. and 60 cents. And I'm glad we had that zero in there to get away from the devil number. I'm just saying, I feel a lot better about this trade now. Okay. Okay.
Now that's our break even. And 1 point on that, some might be saying, well, why is that break even? Well, think about it. If we paid $64.97 for the stock, and then we sell it at this profit and loss graph, remember it's at expiration. So this assumes that we fast forward all the way to expiration day and we are sitting at 66.60. Well, if you bought the stock at 64.97 and it's now worth 66.60, you are up $1.63 in the stock. So you can sell your stock for $1.63 gain. But guess what? You paid $1.63 for the puts, and if you're at expiration, they're now worthless. So why did we break even? Because our put loss is the same amount as what our stock gained, and thus you're break even. You have neither a net gain or net loss. You took a loss in the put and a small gain in the stock, which offset each other. So that's your perfect break even price at expiration Friday.
Your cost of the stock was $64.97. The cost of your option is what? It is
$1.63.
$1.63 for a total of what?
$66.60.
$66.60 in cost, right? So that is where your cost is. Well, if you put in at $66.60 at expiration, if you're sitting at $66.60, you haven't lost anything, you haven't gained anything. That's why this is your break-even point.
Perfect.
Now watch this. So this was really easy to do. We took the strike and our max loss. Now catch this. How do you draw a risk graph of a protective put? You find the strike and first you find your max loss. This is the first point you draw. We'll put a 1 here. Then you find your strike, 2 here. Then you find your break-even point, 3 here. Now we have 3 points. And we draw our line, and you now have a risk graph.
And it keeps extending forever.
Yep. For infinite.
No cap on the upside.
For infinity. Now we're hoping that it'll hit 72. And if I'd have drawn this accurate at all, that would be about, here's $500. So about 540 is about right there. So not a pretty darn good job. I'm going to pat myself on the back because here's
nicely done.
400, 500, 540, bam. And there's our risk graph. Now, this is pretty cool stuff. Now, here's what's interesting is the only thing we have to do is put in a target loss here. And we're buying the stock. We're putting this in about 65, right?
Yeah, and 64.97 is the price of the stock.
Okay, so if it's 64.97, watch this. At 64.97, which is about, what would you say, Corey? About right here, would you say? Right?
Yep.
Okay. Well, I'm going to have that $1.60 if I get out today. Remember, risk graph has the black line, which is at expiration, but the green line is today if I want to get in and out. So if I get into this deal at 64 or $65 roughly, right? $65 roughly, and I get right back out, I wouldn't lose anything. Isn't that right, Corey?
That's right. In other words, if you get into a trade, you could pretty much unwind the trade and get right back out
immediately
where you got in, essentially, right? So
the spread was very small.
If we bought the stock at 64.97, we can pretty much sell it back right at that same price. And if we bought the option for $1.63, we could turn right back around and sell it back to the market for the same value. So you're not at a loss when you put on a trade. You're at break even because your put's still worth what you paid for it and your stock's still worth what you paid for it.
Now I know that the delta at the money is going to be about 50, right?
Yep.
So that means that if this were to make a dollar move from 65 to 66, that means the delta is going to go up about what? 50 cents.
50.
So times 100 shares, I have $200 here. So I'm going to go up about a fourth of the way, Corey. Would you buy into that right there?
Yep.
I'm going to make a little dot right there, about a fourth of the way. I also know that if it goes down, right, Corey, and it goes down, it's going to be about the same, about $50, about a fourth of the way. You follow? And so I get to do this now around this area. If the delta here, we can figure out the deltas here, but at this point, I could pretty much say it's 1-to-1 about right here, right? And I get to do this, right, like this, coming down, and it would look something like that. That was not a very good one, free-handed. There we go. I like that one better. And this is my time decay. And time, if you remember, is the enemy. So every day, this is going to move down. It's going to move more to look like at expiration, right? Every day towards expiration, this green line will begin to take the form of the black line. That's why time. But this is going to happen very slowly. Why? Because we have a 3-month option. That's going to tick away very slowly. Well, let's say that I don't want to wait and take this whole $600 loss. Let's say the stock starts to fall to 64 or 62. I might decide at that point I want to leave this. Is that right, Corey? Could I do that? Could I say,
absolutely.
what? Could I say, I only want to take a $200 loss right here. That's all I want to take is a $200 loss right here. So maybe my target loss, maybe I change my mind and I say, I'm only willing to lose 200 on this, and my protective put might help me do that. You'll have to see. So that's an idea. How would you do a target loss, or would you just go for the max?
Yeah, you would oftentimes use your chart, your technical analysis, and you'd say, where's my next level of support? If support breaks on me, then why not take this thing off at less of a loss? If my confidence is now pretty low that I'm in the right spot, hey, taking a $300 loss is a heck of a lot better than taking a $660 loss, right? And if support has broken and this stock's not acting right, we've got 2 months left expiration, but it's going the wrong direction, I can sell my put back, get a ton of time value back, take a smaller loss, and that's good trading. So now, perfect example.
Okay, now I'm not going to make you right now. We're going to go $660 and $66.60, right? We're going to take our max loss of what was it, 540? Is that right?
Well, no, 660. 660 was the max loss.
Our target profit was 540.
Target profit was 540.
So we have a
max was
$660 loss. And I'm gonna take this break even point in the strike, and again, number one, we go to 660. So here's 700, 800, 600. So 660 is going to be right about there, between 600 and 700. My strike is $60, right? My break even is, let's see, here's 67.
60.
Here's 67. So we're going to go right about there. So 1, 2, 3, and you have a risk graph.
Your risk graph.
Okay.
And notice at 60 or lower, it's all flat. That's your max loss at expiration of 660, because it doesn't matter what share price it falls to. We get to turn around and sell the shares at 60. Remember, we bought the put from the other trader originally, and that gave us the choice to sell the stock for $60 at any point in time through expiration. We're going to sell it at 60 if it's worth anything less than that.
Now, here's where you'll learn a lot about your personality. Actually, this is fun to figure out. If you're a crossword puzzle type guy, if you like word searches, if you like little riddles and stuff, it can be really fun to do these. It can be way fun. And Corey and I decided, rather than using software to do the risk graphs, we know the power of drawing these yourself, because you really begin to understand the options. And one of the things we said, that if you will practice this, I'll be truthful. Corey, do you use risk graphs a lot in software?
I don't. I draw them up, and in terms of strategies and whatnot, I can kind of use them in my head essentially, so I can calculate a lot of these things. But every once in a while, if I'm doing ratios and some different, killer combos, I'll double check it.
You might draw one out. But the fact of the matter is this is fun to do. And if a person does this, can you feel an assignment coming on? I can. If this is fun, if you could have some fun doing this, right? In finding this information. So here's where you get good at this stuff, okay? You start, okay, with the first pillar, and you find 5 stocks that have some good fundamentals. You go to the second pillar, and you do the technicals. Then you do the cash flow, and this is where your work begins. We start with these 3 first, then these 3 next, then these 3 last. And it's all in your option chain. Every bit of it's in your option chain. And once you have these, okay, then you're going to be able to rock and roll, and you can figure out what your up will be, your down will be, your sideways. You put them in the trading journal, and then you can draw your risk graph. Now, last thing, and then we're going to do a little homework. To trade this, okay, we're going to put in the Corey Halliday Toilet Training Company. We'll train you to train your kid.
Love it.
We will train you to toilet train your son. We have methods for doing this. We're going to use a protective put that will do the whole thing in one shot on 100 shares. We know that the price is at 60. If the total price is going to be $66.60, and that will.
And a lot of times a broker will call that a debit. They'll have a little button that'll say debit or credit. This one would be a debit because we're paying that money out.
Paying money out. Okay. With we're going to go with a limit order, which means
make sure we pay $66.60 or less.
Or less, which means we need no stop price. We need no stop price on this one. Okay. Now this is kind of an interesting one because we're going to buy both. We're going to buy both the stock and the put. Isn't that right, Corey?
That's right.
So to open this trade, even though it's 2 of them, they're the same. So we're going to click buy to open. Okay.
Yep.
And we decided that these were 100 days out. So it's probably out here, according to this one, whatever it was, 100 days. I can't remember. I think it was December. It's not on here, but it was 100 days out. So we wanted 3 months, 100 days, right? Our strike price would be, I should have changed that.
Would be 60,
our strike price is going to be 60. It's not going to be 57.50 or 55 or 62.50. It's going to be 60. And then we're going to make this order good for the day because it's an open. And there's your order entry. So take notes on that. Protective put. And you could also do this on the stock side. You could do this separately. You could buy the stock and then you could buy the option. And I recommend you paper trade and practice with both, depending on which is easier for your brokerage. Okay. And then we hit review and send. And that's it. I mean, that's the order entry. Very simple and easy to do. Comprehensive, man. Let's review.
Very, very cool.
Very easy stuff here. You want bullish fundamentals and bullish technicals. We went through this. We know strong markets, what a strong company is, our EBITDA, our PEG, our cap, the right price. If we have a dividend, that's a plus. We know that on the technicals, if it has that gapping personality, that's a big thing, but we want to identify an uptrend, say, hey, is there any pattern that concerns us? That's what we're looking at in technicals. Cash flow, we know that an increase of price makes us happy. Okay, time, that's not going to make us happy. That's against us. Increase of volatility make us happy. To place, once we have this info, this is the info side, this is the action side, right? So over here we get the info, and once we get the info, we got to take action. So what position are we going to take? The position is to buy stock and buy a put for a protective put. We're going to buy these. You can buy them at the money, but we preferred and gave, I think, a pretty good case for considering an out of the money as well. They can do them at the money. We probably want our protective put below support, because if we have support here and the stock comes down and bounces, why worry about it, right? It's when this comes down that we really need the protection if it breaks it. We want to have plenty of time, 3 months or more, and a nice low delta, which equals a low premium, right? A lower premium, we should say, out of the money, lower premium. Our basic guidelines we saw that we could do is we could roll out, we could roll up, we could roll down, and there was one more we snuck in there, is we could buy the dip. And these are the adjustments we would make. And depending on whether it went up, down, or sideways, those adjustments we would make. If the price were to go against us, price down, then we're going to roll down and out, possibly sell our stock or keep it and go buy and buy more. Okay. If it were to go up, then we would probably roll up and out. If it were to stay the same, we would roll out and make sure we have a time stop. We could put that in there as well. A time stop. Don't really have to put that in. Most common sense people know that. So pretty easy stuff on the protective puts of how we handle the risk and handle all three directions. Here you go. This is what you're going to do this week. And so, this is a big thing here, Corey, about fall in love with the process. There's people have this. Let's white this out for a minute. There is the result, and I talk about this a lot. There's the result of having more money and, being, more financially free and having a lifestyle that's fun. Just this morning, Corey, I was trading, and, my son is 12 years old. Lifestyle. How do you spell lifestyle? And my son's 12 years old, and it's fun because I'll let him push the buttons on the software to sell and buy, and you'll hear the bing bing when it goes in, and he just loves doing it. And so everybody loves the lifestyle of a trader, right? However, there's a process you go through to do this, so we'll just make this like the process. And, you might think of this like, a butterfly maybe. That's a really bad butterfly. And, we got our our little caterpillar, over here going in. And here's the thing. Everybody just loves this. They're like, oh, yeah, I love this. I want this. But the question is, who loves this? Some people don't. And, for me, I don't exercise.
Yeah.
I would love to have the six-pack abs like you, Corey. I'd love to have abs like your six-pack. Everyone wants to break off a piece of Corey Halladay. I'd love to have the result, Corey Halladay six-pack. But, I haven't enjoyed the process as much. For me, it's not something to enjoy. So the question is would this be fun to get good at? Now, my wife, on the other hand, she's insane. Okay. She really is. She goes to the gym and she's about a 2.5 hour a day girl. I mean, she does tons of cardio, tons of weights. And so she's about 2.5 days, and she really does have abs. She's got them, and she likes to remind me that I don't. And so what she'll do is, I don't know how many sets of this stuff she does, but this is the type of stuff she does. She just really enjoys it, and she looks forward to getting her water bottle on, throwing on her little Lululemon outfits, and heading over to the gym and doing her high fitness to the music. And, they do these dance moves, and they do it together as a group. And she has friends that she meets, and they lift the weights together. And it's just really, really fun for them to do it. So the same is true with trading. And so, I recommend you build your program, how you want to build it. This is mine. You might want to add more fundamentals to yours. You might want to add more technicals to yours. This is probably going to be very much the same, but, I recommend that people, build a program, whatever it is you like to do. If you don't want to lift weights, or if you like weights, put some weights in there. If you like treadmill rather than jumping jacks or jump rope, put it in there. But it's important to have a system. Can you talk about, it's like offense and, it's like different defenses. You can play zone, you can play man. Both of them can stop an offense. Zone can stop it, man can stop it, triangle and 2 can stop it, box and 1, press, 1-3-1 trap, whatever you want to use. It's just really how good. Jim Boeheim at Syracuse has a great zone offense or zone defense, and other guys like like West Virginia and Bob Huggins, they do they like a 1-3-1 trap once in a while, and both teams are very, very difficult to beat, and both of them are effective. So talk a little bit about having a system, Corey.
Yeah, every trader needs to develop their own system, because as traders, everyone's situation is different, right? The amount of capital you have, what type of risk you're looking at, whether you're kind of searching for growth or income, whether you put more emphasis on fundamentals or technicals. It's not a one-size-fits-all. Yeah. You might find that as you go through these strategies, you're like, oh, that is my bread and butter style trade. That fits perfectly with my personality. And then you look at some other strategies and you say, you know what? I don't manage that type of trade very well, and I don't like that style. It just doesn't fit with my personality, and that's fine. That's what you should do as a trader, is find what fits well for you and really focus in on that. And so you should paper trade all these strategies, but refine this. This is our system. These are the things that we want to check and make sure of. Add and subtract and find the right fit for you. But this is a good starting point. Certainly as paper trading, it's going to help you to figure out, okay, what strategies do I really want to focus in on, and which ones am I not as interested in? By paper trading them, you get the full effect of getting in, managing the trade, getting out, seeing the results, seeing how you manage yourself through that process, what type of emotional responses you have, and how you're able to manage your own emotions through it to make sure that you're not, creating problems and so forth. And that's all part of the process. So you're really going to find your niche. And that's what we always emphasize in developing a system, is make sure it fits you and what you're trying to accomplish.
So I'll tell you this looks like a lot. It looks like a long list, but one of the things we did before we got to this point is we talked about searching for stocks. And there was a section on searching for ideas, and Yahoo Finance is basically free. And we talked about, the stock screener and the fundamental screens that start right here. And you can set up every single one of these in Yahoo Finance and run a search for candidates. And then you look at their chart, and if there's an uptrend and a pattern, you're money. You're going. And once you get to that point, it takes 1 second to push that button and find candidates, and maybe 5 minutes. So let's just add this up. You probably got 5 minutes to go through those candidates and find some uptrends. So look at this. Does it have a large cap? How long does that take to see whether it has a large cap? You say yes, and that takes about 1 second. Is the price bigger than 10? That takes 1 second. Is the peg is the peg lower than 1? That takes about 1 second to say yes or no. And is the enterprise value over EBITDA less than 10? And some of them might be yes, and some of them might be no. You might do one over here that might be a no. Then you say, okay, does it have an uptrend? Does there a recognizable pattern? I say, oh, look, this is an ascending triangle, or something like that, right? I check my support and draw a line. I check my resistance and draw a line. So, once you get this done right here, I'd say the fundamentals could be done in maybe 1 minute or less, and the technicals could be done in 1 minute less. And I'm being generous. You could really do these in 30 seconds. Okay, is this there? Is the volume over 1 million? Maybe it doesn't have a gapping personality. Okay, then I put in the stock price I'm going to buy it at. $50 right there at the money, just because I'm paper trading. And then I'm going to look at what strike, and here I'm going to do an at the money strike. So I'm going to go at the money on this one. What's the premium? Maybe the premium for this option at $50 is maybe $1 premium. What's my expiration date? Well, I know it's going to be 3 months or more. My delta might be 20. My theta might be a penny. My vega might be, 15 cents, something like that. Do I have the proper option volume, spread, or open interest? I say yes. Maybe it's got, 2,000 contracts. I look at the probability. My delta is going to tell me that. So there's a 20% chance I'll need the insurance. And then I would say all this maybe takes 2 minutes, and it's faster once you get good. And then right here in the order entry, that's going to take, if you're starting out, we'll give you maybe 3 minutes to figure that out. After a while, that takes less than a minute. And your trading journal you might spend a little time in that and take, maybe 3 to 4 minutes on that, on the journal. So 3 to 4 minutes there. So I got that done. Building the risk graph might take you 5 minutes, 5 to 10 if you're new. Corey and I can do it in less than a minute. So you get your risk graph done, and then you're done for a while until you just adjust. And, these might take a minute here. So that's 5, 10, maybe 15 minutes to do one of these. So you do this one on Monday, Tuesday, Wednesday, Thursday, Friday, and Saturday, and take Sunday off. And just practice these. Do 3 at the monies, do 3 in the monies. And I'll just tell you, just like my wife gets insane results by just doing this, every day, each week. She might do a set of this, each of these once a day or however she wants to do it. She has her system, and don't mess with her system. You can mess with our system if you want, but just understand, even though that seems like a lot, just, this is like boom, 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 boom. You'll get to where you can do this stuff and check this stuff very, very fast to be part of you. But the only way to get fast, I know of, if you want to, is to enjoy the practice. She's good at this type of stuff because she does it every day. And this is how you develop what's called a habit. And we talked about the mindset of the trader and how habits turn into actions that turn into results. So this is what traders do every day. And we do these for, this is the first strategy. This is a long class. The others will begin to go faster because, we're introducing concepts, right, Corey? I mean,
that's right.
We're going to go faster and faster as this goes on. So, big 2.5 hour class to start. Well, that would make sense when you do it for the first time. Sit down with your trainer. After that, man, this is going to go fast. So,
that's exactly right. It basically will reduce your amount of time, both in our classes, but in what you're doing, paper trading. The more you get used to the process, how much quicker are you going to be able to do it? So it's kind of like starting a new job. At first, you kind of feel a little overwhelmed and you say, am I ever going to understand this? And then it gets to the point where you're so used to it, It's just natural. But hopefully this is something that you really enjoy, you have a passion for, and it shouldn't feel like work. It should feel like the
fun.
Excitement of going and finding a new candidate and a great trading opportunity.
And especially since it's on paper, there's no pressure. I mean, you're going to see things, you're going to get, this is how, tree rings, come once a year. And this is how you get your tree rings going. That's a really bad tree stump, isn't it? But tree rings, we should make them like that. That's a little better. Tree rings go once a year. This is how you earn your tree rings. By paper trading and observing and not passing judgment on whether you did well or whether you didn't do well. You're just entering a process. Someone who's doing this should not pass judgment on themselves the first day in the gym, especially if they look like me. If I can only do, 2 of these, and I can only do 10 of these, and I can only do, 30 of these, I might be pushing it, 20 of these, and I might only be able to do that for 15 seconds on my first day. But after a while, I'll be doing 20 of these and 100 of these and 100 of these. And, I can sit here for, a minute, 30 seconds after a while. So I'm not going to pass judgment on my first day in the gym. I'm certainly not going to pass judgment if it takes me longer than 5 minutes to do my first risk graph. But this one will take you less than 5 minutes. I'll tell you that right now. So that's going to be fun. So move along the continuum. And after you've done, those one each day, for this week, once you've done it one each day, feel yourself moving here. You'll feel it happen. And I'll tell you, if someday you want to really go to the moon and get a mentor or some small group coaching or get in an investment club or something, if you come there already knowing how to do that stuff, forget about it, man. You'll be awesome. So let's finish this up. Kind of a longer class, but an important class. It's the first one on strategies. Protective puts, risk management strategy when you own long stock. Of course, it's a long stock and a put. We prefer the out of the money and buying them 3 months because the premium's lower delta. Just a better Greeks all the way around, in our opinion. We'd rather have cement truck insurance. We can live with a little drawdown. That happens. But we don't want to get crushed in something. We adjust things by rolling up, down, out. We also talked about buying the dip, which was a fun little secret. And I'll tell you one thing I'd be remiss just for fun. This is not the end of this. You could have one of these that looked like this that we talked about. But if you get ahead in a stock, you could buy two. You could buy two of these. You could buy two options, right, Corey? And you could actually get something that looks like this and have a time decay graph that looks like this, to where you're looking up and up pretty happy once you get ahead in the stock. So this is not the end of using puts and options. I mean, there's a lot to do, but these are the basics, okay? Very conservative strategy. This is $100,000 strategy over the life of a trader that grows a significant account and decides to do this in a big way. You can save tens of thousands of dollars one position by having this, depending on how big the position size is. You get the last word, Corey.
Well, practice makes perfect. Make sure you're paper trading these. Congratulations, everyone, on getting to this point. We're now into strategies. I hope you're having as much fun as we are. This is fun stuff. It's educational, it's instructive, and it's just so awesome to learn how to put risk management in place so that you make sure that you have limited risk on your stock positions when it's needed, and you can even monetize those puts and turn them into more investment and all of these things we talked about. So it's a lot of fun. Great job.
Fantastic, Corey. And thank you for joining Corey and I. We're going to move on now to the protective call.